Hey, Esther, how many messages did we get in our mailbag this week?
0.
Really?
Really?
I think we should get a new background. It'll help us get more views, and the lighting in here makes me look 5 pounds heavier.
More like 15 pounds.
Can I work with Lindsay on these videos now?
She's busy.
How do you know?
She told me to tell you that if you ever asked.
Okay, 7.5 pounds.
10 pounds on a good day.
EBITDA. What is it and why is it so important? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is a simple proxy for the operating profits of any company. Interest is excluded because this expense is entirely dependent on how investors capitalize the company. Taxes are removed because the amount of income taxes that a company pays are not at all dependent on its operations. They're dependent on the corporate structure, the accounting methodology, and any debt that the company might have. In short, a company's interest expense and tax expense are in no way reflective of its ability to generate cash flow from operations. Depreciation and amortization are expenses that a business owner can claim to lower their taxable earnings by accounting for the declining value of the assets that they've invested in. Depreciation applies to tangible assets, amortization applies to intangible assets. The reason depreciation and amortization are excluded from EBITDA is because these are considered non-cash charges. It's simply an accounting transaction and no cash is actually being expended from the business. Why is EBITDA so important though? EBITDA is the primary way that investors value a company in the private markets. EBITDA is a simple measure of cash flow that is universally accepted by both equity and debt investors. Private equity investors will calculate the enterprise value of a company based on a multiple of that company's EBITDA. Lenders will similarly determine how much money they'll lend to a company based on the level of EBITDA that it has. On an additional note, investors measure the ongoing financial health of a company by looking at the ratio of the company's debt to its EBITDA. How is EBITDA calculated? EBITDA is simply a company's revenue minus its operating expenses. Remember that depreciation and amortization are non-cash charges, and taxes and interest are not considered operating expenses. As such, depreciation, amortization, taxes, and interest are considered below the line. One important footnote on taxes. The only taxes excluded from an EBITDA calculation are income taxes. Companies do have taxes that are considered operating expenses. Payroll taxes and property taxes are easy examples of this. Also, many states levy a franchise tax on businesses. A franchise tax is another example of a tax that affects the operating expenses on a profit and loss statement. Okay, let's talk about EBITDA as it relates to a dental practice. Private practitioners often think that their EBITDA is the same thing as the discretionary income that they take out of their practice as the sole practice owner. Although that view is an accurate representation of the practice's discretionary cash flow or distributable earnings to the practice owner, it is not an accurate calculation of EBITDA. The reason for this is when dentists think about their overhead or operating expenses, they omit a market rate compensation for the clinical work they do as the doctor. A dental practice's EBITDA must account for the normalized market rate compensation for the doctor and the clinical work they do. If you commingle a bunch of your personal expenses, like that monthly Costco run or your cell phone bill, in with your true business expenses, and you don't cleanly account for those, then truly understanding the EBITDA of a practice can be very challenging. Another thing I frequently hear from doctors is that one group told them that they had EBITDA of X, let's say $400,000, but another group told them that their EBITDA was $350,000. Why the difference? Theoretically, if multiple parties attempt to calculate a dental practice's EBITDA, they should arrive at a very similar number. Here are a few reasons why that outcome may vary. Number 1, differences in doctor compensation. If one group is calculating doctor compensation based on 30% of production, and another group is calculating doctor compensation at 35% of production, then there is going to be an obvious difference in the cost of doctor labor. Number 2, human error. There could be an analyst working on the P&L that simply makes a miscalculation or makes an adjustment that should not have been made. And number 3, the most common one, what we like to refer to as pro forma credit. This is the most likely source of difference in EBITDA calculations. Some investors will make what we refer to as a pro forma adjustment to the profit and loss statement. An easy example of this is if a buyer knows that they're going to reduce some of the staff post-transaction, then there is labor savings in some dollar amount that is very easy to quantify. I hope this overview provides you with a super simple explanation of an often misunderstood topic. In a future episode, I will take a deeper look at how we make adjustments to EBITDA.